Apple stock has been making headlines recently, but not for the reasons investors typically celebrate. Over the past month, Apple stock has tumbled nearly 13%, with a single-day drop of almost 9%. For a company synonymous with stability and tech dominance, these numbers are undeniably striking. What's causing this steep decline? And, more importantly, does this present a golden opportunity to buy the dip, or should investors tread carefully? Let's dive into the key factors driving Apple's performance and explore whether now is the right time to make a move. What's behind Apple's recent struggles? Analyst downgrades shake confidence. Recent weeks have seen a slew of downgrades from prominent analysts, raising concerns about Apple's growth potential. These downgrades often act as a wake-up call for investors, casting doubt on the company's near-term performance and sparking sell-offs that contribute to the stock's decline. When influential voices express hesitation, market confidence can falter, as we've seen here. Slipping global smartphone shipments. Global smartphone shipments have been under pressure, and Apple is no exception. Year over year, Apple shipments declined by 4.1%, despite maintaining a commanding 23.2% share of the global market. What's driving this dip? The primary factor is intensified competition from Chinese manufacturers like Xiaomi and Oppo. These brands have shown remarkable growth, with shipment increases of 12% and 8.6% respectively. Their rapid expansion, particularly in Asian markets, has eroded Apple's market share in key regions. While Apple remains a dominant player in the United States, the same cannot be said for its presence in emerging markets, where price-sensitive consumers often opt for more affordable alternatives from Chinese competitors. The global decline in smartphone shipments isn't just Apple's problem. Market leader Samsung also reported a 2.7% drop in shipments. The slowdown reflects broader economic challenges, including inflationary pressures and reduced consumer spending. However, Apple's high price points make it especially vulnerable in this environment, as consumers may delay upgrading their devices or choose less expensive options. Yet, this isn't entirely new for Apple. Historically, the company has faced periods of shipment declines, only to rebound through innovation and strategic shifts. For instance, Apple's ability to differentiate itself through premium hardware, software integration, and ecosystem advantages remains unmatched. While shipment numbers may fluctuate, Apple's loyal customer base and brand equity give it a unique resilience compared to other manufacturers. Another critical aspect is Apple's pivot to services revenue. As hardware sales face challenges, the company has doubled down on expanding its ecosystem through offerings like Apple Music, iCloud, and Apple TV+. These services provide recurring revenue streams, which are less sensitive to economic cycles and consumer behavior than hardware sales. In fact, services revenue has grown by $11 billion year over year, underscoring the company's successful diversification strategy. Despite this diversification, declining shipments still have implications. Hardware sales are a major driver of Apple's ecosystem growth, as new device purchases often lead to increased adoption of services. If shipments continue to decline, it could eventually slow the growth of services revenue. Additionally, declining global market share may signal that Apple needs to adapt its pricing or product strategy to compete more effectively in regions dominated by value-driven consumers. In the short term, these shipment declines will likely weigh on investor sentiment. However, Apple's long-term prospects hinge on its ability to maintain its premium positioning while addressing competitive pressures. The company's focus on innovation, coupled with its growing reliance on high-margin services, may ultimately offset the challenges posed by declining hardware shipments. Apple's enduring strengths. Despite recent turbulence, Apple's core strengths make it a formidable player in the tech landscape. Here's why. Impressive profit margins. Apple's financial efficiency is nothing short of extraordinary, setting it apart in the tech sector. Over the past 5 years, the company has demonstrated remarkable prowess in maintaining and expanding its net profit margins. In 2023, Apple achieved a net profit margin of 26.5%, significantly higher than the industry average. This impressive figure is not merely a product of its premium pricing strategy, but also a testament to Apple's meticulous attention to operational efficiency. By tightly managing supply chains, leveraging economies of scale, and employing sophisticated pricing models, Apple has consistently delivered robust profitability even in turbulent economic environments. Moreover, Apple's vertical integration plays a crucial role in these margins. From designing its own chips, like the A-series processors, to developing proprietary software, Apple controls much of its production and user experience. This not only reduces dependency on third parties, but also allows for higher profit retention. For instance, the transition to in-house chips with the M-series for MacBooks and iPads has not only boosted performance, but also slashed costs associated with outsourcing chip manufacturing to companies like Intel. What's more, Apple's high margins provide a buffer during periods of economic uncertainty. While competitors may struggle to maintain profitability during downturns, Apple's financial cushion allows it to weather challenges while continuing to invest in innovation. This resilience further cements its position as a leader in the tech industry. Another factor contributing to Apple's profitability is its ability to upsell and cross-sell within its ecosystem. For example, an iPhone user is more likely to invest in an Apple Watch, AirPods, or even subscription services like Apple One, further increasing customer lifetime value. These ancillary products and services come with significantly higher margins compared to hardware, reinforcing the company's overall profitability. It's also worth noting that Apple's focus on sustainability and recycling initiatives has added a layer of cost efficiency. By reclaiming valuable materials from older devices, Apple reduces production costs while simultaneously enhancing its brand image among environmentally conscious consumers. This dual benefit further solidifies its market positioning. Lastly, Apple's pricing strategy deserves special mention. While its products command premium prices, the perceived value among consumers justifies the cost. Apple has mastered the art of creating demand through scarcity, limited product refresh cycles, and marketing campaigns that position its devices as lifestyle symbols rather than mere gadgets. This emotional connection with its audience allows Apple to maintain pricing power that few competitors can match. In summary, Apple's impressive profit margins are not a stroke of luck, but a result of deliberate strategies and operational excellence. They not only highlight the company's financial health, but also serve as a cornerstone of its long-term sustainability and competitive edge.